All right. So we will get started in just a minute, and we're going to be doing our self-employed borrowers who I feel like are hibernating at times because they've been neglected with financing. So we're going to go over how we can help people who are self-employed. And for any of you who are joining in your real estate agents, that does include you. And I get really excited about this topic. So I am going to just give it about 1 to 2 minutes here, and then I'm going to get started. And if you miss any of this, we will have it as a replay so you can watch it back. So hang tight for 1 minute and we will be back on. All right, so let's get started. So today for our 15 to 20 minute webinar, we're just going to go over some self-employed borrower tips, suggestions, helpful things that most home buyers do not know. And that I find once they find out after the fact, it's a little too late, so they have to wait. So if you can be educated on how to help your clients who are self-employed, it's really going to go a long way, and it's going to help them qualify for a ton more when they're looking to buy. And so, you know, I had said for anybody who'd signed on, if you are a real estate agent or you're in a profession where you get paid a 1099, you're self-employed too. And it's one of those areas in life that a lot of us don't know a lot about. I'm very fortunate that my degree and where I started my career was in accounting. So I had a little bit of an edge going into it, not realizing how much it was going to help me when I got into lending, and how many borrowers get denied and turned down at other banks and lenders because nobody teaches you this. And so one of the key things I would say, just as a overall takeaway, is finding someone who specializes and understands how to help people who are self-employed, who pretty much meaning they pay their own taxes, they file taxes differently than the rest of us. It will make a huge difference in the qualification of those home buyers. So let us move here. So let's just start with, who is impacted, who's considered self-employed. So that's your 1099, people who get paid a 1099, independent contractors, your sole proprietors, your S Corps, your C Corps, your LLC owners. So, and really all this means these, the acronyms here and the different types of businesses, it just changes the type of what their tax return looks like. They're on different forms. Taxes seem really complicated, but they really all tell the same story, and they are the same thing. It's just how they're filed. And a lot of people don't understand them. What's been really surprising to me in the last 2 years, I would say, and even more so in the last 6 months, is who is falling into this category. And so I'm going to make this big real quick. So I just have a couple pictures up here of a lot of attorneys, people who practice law are self-employed. You've got a lot of people who are going into the gig economy. So they're leaving their jobs. I think they're calling it the Great Resignation. I just had a doctor who's been W-2 for years and now doing telemedicine. So this doctor's making even more money, but it's all 1099 income. And he wants to buy $1 million home. And so that's where I start seeing this come into play. And there aren't a lot of people who, like I said, understand this or have the products that they need because it's very individualized. You also have your people doing Lyft and Uber. Maybe they have a W-2 job, but then they have this part-time income that they've started doing, hoping one day they'll, go full-time doing that. People who help with grocery shopping, if you've ever used like Instacart. So there are a lot of people, and pretty much there's no profession, I feel like, that's off limits now for who can be considered self-employed, and it will affect them when they're going to qualify. And so I put up here, if you're not familiar with some of these, we actually use some of them here at Collab Lending. Upwork is an example. There are people who are doing what's called fractional CMOs or CEOs, where they're going into companies, so companies don't actually have to hire a full-time person, pay taxes, pay benefits, and someone will work for a couple different companies. And I'm sure for any of you who sell real estate, when you start working with someone, oh, what do you do for a living? Okay, I'm a doctor, or I'm a marketing director. But, you don't go past that personal line with, well, how do you get paid? Are you 1099, or you work through a company? Is it an independent? Sometimes I'm sure you'll find out, but not always. And so that's why I wanted to continue to point this out today and show you some of the things that will literally help you sell more homes if you can help this group of buyers that is surprisingly here on this next slide. I've gone to a couple different conferences around the country, and they're estimating that the loans that they have been creating to serve these self-employed borrowers are literally going to make up and consist of about 30% of the homes that are sold in our country over the next 5 years. So that's a pretty big group of loans. And from my experience in doing these loans, these specialty loans, a lot of these buyers, they're not your first time home buyers always. They could be, but they're usually a buyer who is purchasing a second home. They're buying a move up home because they've started somewhere in their career, and we're closing ones. Most of them are between 400 to $1 million is where the purchase prices are. All right, so just to have a little bit of a foundation, I wanted you guys to see a couple things, but I'm going to keep it really simple. So cash savings versus cash lending ability. This is the big thing with people who are considered self-employed. So what happens a lot of the time is in the lending world, when we talk to someone and they don't really understand yet how their income works, they will ask them, how much money do you make? And they'll tell us, let's say they're getting 1099s and they're about 150,000. And they'll tell us, oh, I'm making about, $11,000 a month. That's why we always want to get the tax returns if we know someone has any type of self-employed income, because a lot of times then their tax return has a different amount. The 150 is on there, but after the write-offs, it will go down and it will say at the bottom, $50,000, which when it comes to your normal conventional Fannie Freddie loans, they're going to use the 50,000. That's what your traditional mortgages use. And the reason for that, for all of you that sell real estate, I'm sure we're always looking for deductions. So I threw a couple little slides in here that I'm going to share with you a couple deductions that nobody ever talks about. And they save so much money for all of you. And it's one of those things that I've had to teach underwriters when they've tried to deny a loan because they didn't even fully understand it. So I'm going to show you something that could really save you a lot of money if you haven't filed your taxes yet, or if you're doing planning for this year or next year. So I wanted to show you a tax return really quickly. All right. Tax deductions. So this is an S Corp. So I took an S Corp here, and like I said a little earlier on a slide, this could be if you just get a 1099, you have a regular tax return, a personal tax return, and your income goes on what's called your Schedule C. If as a real estate, if you have filed in your, you could do this if you file in your S Corp, you have a separate tax return and it does the same thing. You have the number of how much you brought in total up top. So right here, this business brought in 1.4 million. And then you've got all these write-offs that start going all the way down here. And when someone is self-employed, a lot of times someone who owned this business as an example, they brought in some really good money, 1.4 million. But if you look here, line number 7, compensation of officers. So if this was, let's say it's one person owned it, they took a W-2 of 68,000. And then the total bottom number at the bottom, that number 21, 29,000, that would be the two amounts that we can add up and we can use to qualify them. Now, there are some little secrets in here, which I would say, I hope a lot of loan officers at least know this, but not everyone. So if you look at the little arrow I have, this is where the deductions come in. So this tax return has a pretty big deduction for depreciation right here, 101,000. This is one of those secret deductions that you can do when you own a business. You can do it on a Schedule C, you can do it as an S Corp, an LLC, you can do it under any of the business structures that we went over. You also can add this back to someone's income. So this individual who owns, if it was a single person owning this entity, would get the 101,000, the 68,000 that they paid themselves as a W-2, and the 30,000. I'm going to show you where that 101,000 came from because it's something that everyone can use. You can use it if you take action this year or next year. Where people get really confused though, is they'll tell us, oh, I make a W-2 of 68,000. But let's say the bottom line here was negative and there was no depreciation. They don't realize that even though they didn't lose money because they have money in their account, that negative amount actually gets deducted from their W-2. So, and that's where people can get in trouble and why we push so hard to get the tax returns. But this deduction here, and just in case you don't know what depreciation is when you buy things as a business. So if you buy a computer, if you're a real estate agent and you spend, I'm just for easy numbers, let's say you spend $5,000 on a computer, you typically can take that 5,000 and you can write it off over, let's call it, I think it's 3 years, but you can write off 1,000 of it each year. So the amount is usually small. The reason that one was so big is because there are some special deductions that you can do. So I see a lot of people who, your home office, and it's not just the space. You can literally write off the portion of your mortgage interest, your taxes, your insurance, your electricity. If you do upgrades to the area, there are a lot of things you can include with your home. You just have to multiply it by a percentage. If you have kids that are under 18 and you're a sole proprietor, which a lot of people are sole proprietors, you can actually pay your kids up to a certain amount and it gets deducted. So your taxable income goes down. And I believe, and this is where I'm not a tax professional anymore, your child does not also get taxed up to the amount that you're allowed to pay them and avoid taxes. So you kind of get the benefits of both sides. My favorite one. All right, so cars, vehicles. This is the big one, and this is the one that I see a lot of underwriters missing and that people don't understand. And it's what's called a Section 179 depreciation or 179 expense. So when it's called expense, it's a little deceiving. Everybody can write off, you can write off your mileage, and typically that's what your accountants are going to tell you. You can write off your mileage, or you can write off your maintenance and all the things that add up, your gas separately. So you pick one of the two. For some reason, nobody really talks about how there's a third option. And the third option is that you can actually buy a vehicle as long as it's on a special list. And if you buy that vehicle from the list, you write off the entire vehicle. So I'm going to show you that list. little small here. We can, if anybody wants a copy of this, we can get a copy. You can also Google it. This is the ultimate Section 179 vehicle deduction list. And if you buy one of these types of vehicles on here, it's based on weight. In 1 year, you can write off the entire vehicle purchase. And then you have to hold on to the car usually for 2 to 3 years before you buy another one and can do it again. Then you can write off your gas and certain things in those other years. So you're getting the most bang for your buck with your write-off. It's one of the reasons with the business that I own, I buy a car every 3 years if I need it or not. And I buy a used vehicle. And so I'm going to show you how this works again on that tax return. So if you look here, this business would have reported 130,000 and gotten taxed on 130,000. They only got taxed on 30,000. So it saved this business $32,000 in taxes in 1 year by purchasing cars. So if you look here, it bought 2 cars. Here's the $2 amounts. That was part of that 100,000 in depreciation. If you are a real estate agent listening to this, you can do the same thing. I've even seen real estate agents who buy a car like this and they just don't know to tell their accountant, and they end up not writing off this depreciation. There are some stipulations to it. So I always say, work with someone that you can plan with. But it is one of the absolutely best things that you can do. And gosh, you guys put tons of miles on your cars, tons of them. So, years, you need your money for something else, strategize and plan and look into buying a car like this, because by the time you get all that tax savings, that's how I've always looked at it. I'm saving so much in taxes that even if I have a car payment, I'm still saving money long-term than paying 30,000 more in taxes that year. So I wanted to share that one with you because it's one of those ones nobody talks about. But I've also sent loans to underwriters and they have not added the cars back until I've had to send them documentation explaining what this is. And so once again, that's why it's so important to talk to somebody who understands tax returns, who understands how to help people who are self-employed, because not everyone's going to be able to get qualified. Some things you can't add back. There's the kids there. So get your kids working, keep a log. All right, now we're going to dig into these last few strategies for helping yourself and for helping your home buyers. So it's a little light there, but bank accounts. What is the big deal with bank accounts when people are self-employed? So let's look at an example. So Fannie and Freddie, who do our conventional loans, our FHA loans, our all our loans, they're the ones that back all of our loans. The big deal with bank accounts is that we'll use the example for you as a real estate agent. If you have a personal bank account, let's say, and we'll keep using the same example, and your 1099 that when you sold real estate this year and you made 150,000, but you wrote stuff off down and your taxable income is $50,000. That means that the monthly income that you would have if you're trying to get a conforming loan would be $4,100. So that would be the base income we'd start with. And let's say you're doing a loan where they won't let you go over 41% debt ratio. That means $1,700 is the most you can have for house payments and all other debts. So if you have, let's say, a personal credit card that has a minimum payment of $250 and a car loan for a payment of $400, well, if you look below here, if everything is done out of your personal bank account, meaning you get your commission check, it goes into your personal bank account, you pay your car out of your personal bank account, that means that you would qualify for $1,058 for a mortgage payment. If instead you knew that you opened a business bank account in addition to your personal, and you deposited every commission check into your business bank account, and you paid your car there out of that business bank account, and you paid that credit card from that business bank account, and then you transferred into your personal account, whatever's left to use for your expenses, we can actually exclude the car and exclude that credit card payment. Whatever you pay out of a segregated business account, Fannie and Freddie will allow us to exclude it. So now all of a sudden, someone who is self-employed who does this goes from being qualified for $1,000 payment to a $1,700 payment. So that's adding about $130,000 to $140,000 in purchasing power. It makes a huge difference. So that is a really big tip, and you have to be doing it for 12 months. So if you don't have your finances set up this way, or if you talk to a client and they don't, recommend it because it will make a difference. All right. So if somebody needs to buy now and they cannot take 12 months to move their information and they've fallen in love with a home, that's where other loans are going to come from. And so we're going to dig into these because I'm sure a lot of you have heard of bank statement loans, and we'll jump back to this ones, but these are the new loans for the gig economy, which we have heard that there are some banks that are starting to explore these loans. But for the most part, you're going to find them at mortgage brokerages. Not all brokerages have them. Brokerages can have different products. They're very specialized. And so if a broker has one bank who does them, or if a broker has 10 banks who do them, they are portfolio type loans that all have their own rules and regulations on them. But they're being made because of what they're seeing coming in the housing market. So the main three types of loans that are out there are bank statement loans, investor cash flow loans, and asset depletion loans. Those are the three main ones. There are more, and they can be done lots of different ways, but I'm going to keep it simple today and just help see how much more someone would qualify for compared to our example we've been using from above. So your bank statement loans here, like they sound, they use a self-employed borrower's bank statement. That's it. They don't collect tax returns. They don't collect W-2s. They don't collect 1099s, although there are 1099 loan programs. So there are other options, but a bank statement loan just gets the bank statement and they add up all the deposits. And instead of using that 50,000 from before, they're going to use, if the deposits are 150,000, that's what the monthly income starts at. The investor cash flow uses, I'll make that bigger. The investor cash flow uses leases, or they use rent that's on the appraisal. So if you have an investor who doesn't have a W-2 job, they don't need to have a W-2 job. They can actually purchase an investment property by either the leases or by the appraiser stating how much the rent is projected to be once the house is rented out. And you can use these investor cash flow ones on not just 1 to 4 units. We've used them on 10 units, 12 units. It just depends. We have to find the right investor. And a lot of the banks who do these, you can do them either in an LLC or you can do them in a personal name. And then asset depletion, that's for your people who don't have reportable income, but they have a lot of money sitting in their bank account. And the best example for this one is somebody who's retired. If someone's retired, what I see a lot of people recommending is, hey, start pulling money out of your IRA, because we can do that with people of retirement age, and we can use that income if they start pulling it for a few months, but they have to pay taxes. So if they can do an asset depletion loan, they don't have to pull it out. We can just use the money that's in there, and we get to divide it by a certain number and use that as monthly income. It's pretty neat. So this is an example of that same example. Somebody who makes 150, their taxable income is 50,000. So before we went through it, they were qualifying for about 1,000 to 1,700. Well, now with a bank statement loan, as long as the deposits are all in their bank account, and since Fannie and Freddie's out the door now, they don't care where it gets deposited. They're going to take all the deposits and they get to use 12,500. They use that same debt ratio. So now that person is qualifying for a $4,475 payment, which makes a huge difference. One of the biggest things that people will say about these loans, and so this is where it's really important to be on the same page with this, is, but the rates are higher, right? The rates are higher. I don't want that high of a rate. I'll report my income so that I can do a regular loan, because everyone is so focused on the interest rate. So what I like to do then is say, well, hold on a second. Let's think about this, because I worked with someone who went to a local bank and the local bank told him to report his income, and he did for 1 year. He reported, instead of 22,000, he reported close to $80,000. And he's like, I just need 1 more year and then I can buy a home. That wasn't, we could help him buy a home, and it's going to cost him a heck of a lot less, because when you look down here, if somebody stays reporting 50,000, roughly, their taxes due, depends on a lot of variables, but they owe about 10 grand. Their interest rate, let's say, and I'm just ballparking here, it's going to be higher. If regular rates are around 4, your portfolio loans are going to be anywhere from 4.875 to 5.875. So the interest paid is 16,000. Now let's look below. If they go and try to report more money, not do any write-offs so they qualify, now they're paying 3 times as much, almost 4 times as much in taxes. And yeah, they're saving on their yearly interest on their mortgage, but it doesn't really make sense. And that's where it comes down to the price versus the cost of the decisions when it comes to stuff like this. And so I try to show people this, and our team shows people this, and it tries to explain that. Yes, the rate is a little bit higher, but keep reporting what you are. That's what these loans were made for, and it will save you money over the long haul. All right, bring this back. All right, so our main takeaways, I just want to review is that, first of all, we're just offering information. What's good for one person could be different than what is good for another. Always consult your tax professional for advice for your own individual situation, for clients. But most importantly, educating yourself and educating your clients on this stuff is so, so, so important. Be an advocate through education and learning, and get them to talk to an expert, someone who is a loan officer or a team that specializes in helping self-employed borrowers. Bring this back up. I had a real estate agent who ran into me a month or two ago, and I had looked at their tax returns last year, and I let them know. I said, hey, I really think you're overpaying in your taxes. Like, I could be wrong, but like, holy crud, like there's got to be write-offs you have. Didn't you buy a car? Like, I ran into them. So now this is 6 to 9 months later. And I have a video of it, because it made me feel so good, because that's what we all need to do, working together. And the agent came to me and said, I owed $125,000 in taxes between, it was 2 or 3 years. Took to an accountant. They redid the taxes because write-offs were missed. And that 125 went down to about 30,000. That was 95,000 in taxes over 3 years that they saved. So, just driving home that point of, looking out for each other, working with people who, have a specialty, have a passion for these types of loans, for you as a professional, for your clients, because so many of them get told they can't get helped, and they just go to their bank where they have their business accounts, and then they're deflated, they're embarrassed, they don't want to talk about it, and it's not their fault. It's just getting them to the right places to get the help that they need. And so our last slide here before, if anybody has any questions, this was a cute little one that I found. Dear IRS, I'm writing you to cancel my subscription. Please remove my name from your mailing list. So I wish they would remove my name from their mailing list. I'm sure you all feel the same. None of us enjoy tax time and doing that, but it can get a lot better, and it can definitely change. So I hope that helped all of you a little bit with some self-employed and tax stuff. There is a lot more to it, but I just wanted to give you guys a taste and just make sure that I was giving you something. You can reach out to anyone here at Collab Blending, anyone on our team, and we will make sure that we send the follow-up. I don't think I saw any questions. I don't have a helper today. I'm looking here. But if you have any questions, please feel free to type them in and I will try to answer them here. Otherwise, we will be here next week. And I think we're doing just some really simple intro to video tips and techniques if you've ever wanted to use video in your business. And it's video without having to use it on social. So just some different techniques that you can integrate it into your business. So once again, I'm Megan Marsh from Collab Blending, and you can reach out to any one of the loan officers on our team if you have questions about self-employed loans or have a question about the information on our webinar Wednesday. We'll be back next Wednesday at 12:30. Thanks a lot for joining today, guys.